Hey everyone, welcome back. So in our previous lesson, People, Documents, and Accounting, we essentially built the revenue cycle machine, right? We mapped out exactly who owns what stage and how those accounting entries flow from that initial sales order all the way to the bank. But, building a high-performing machine is really only half the battle. In this explainer, we're going to look at how we actually protect and measure that machine. Now that you've got the foundation of who does what and how it's recorded, we need to talk about what can go wrong, how we prevent and detect those failures, and ultimately how we measure the financial health of the entire cycle.
Okay, let's dive into this. Here's our roadmap for today. Number 1, defending the cycle. Number 2, preventive versus detective controls. 3, navigating key risks. And finally, 4, measuring health with KPIs.
All right, kicking things off with Section 1, defending the cycle.
Think of internal controls as the essential safety switches we've absolutely got to install directly into our revenue machine, because without them, a single human error or a weird system glitch can literally cascade into a massive financial loss. And these controls fall into 2 distinct buckets, preventive and detective. Now, both are absolutely crucial. The easiest way to wrap your head around this is to think about fire safety in the workplace. Preventive controls, well, those are the measures that stop the fire from ever starting in the first place, like keeping flammable material safely locked away. Detective controls, on the other hand, are your smoke alarms. They catch the issue after it has occurred so you can put it out before the whole building burns down. You really need both to stay safe.
So let's look at 5 key preventive controls. Our fire prevention. First up, discount and pricing approval thresholds. This simply ensures sales reps aren't giving away the farm just to close a deal. Second, credit approval before a sales order. This stops us from selling to someone who, frankly, can't pay us. Third, sales order approval before fulfillment. This keeps the ops team from wasting time and resources on unvetted orders. Fourth, generating an invoice only after delivery confirmation. This completely stops premature billing. And finally, segregation of duties. Guys, this is a massive one. Segregating duties across billing, cash handling, and reconciliation eliminates single points of failure. If the exact same person who bills the client is also reconciling the bank, you've got a massive blind spot for errors, or worse, fraud.
Okay, let's move over to our smoke alarms, our 5 detective controls. These are the routine audits we run to catch things that might be slipping through the cracks. First, reviewing the accounts receivable or AR aging report on a weekly or monthly basis helps us spot overdue invoices early. Second, a revenue versus billing reconciliation each period. This just ensures what we actually billed matches the revenue we recognized. Third, reconciling cash receipts against the bank statement, making sure the money actually landed. Fourth, running exception reports. This is where we look for weird anomalies, like negative AR or unapplied cash. And fifth, revenue trend analysis. We're basically looking for unusual spikes or drops that might point to a systemic processing error.
Moving right along to Section 2, navigating key cycle risks.
So, what actually happens when these controls are missing or people just skip them? Well, we invite immediate business impacts, and the crucial point is understanding this direct cause and effect chain. Look at Step 1, the root cause. Let's say we have no approval control on pricing. This directly leads to Step 2, the risk, quote errors, and then boom, that materializes in Step 3, the impact. Wrong revenue gets recognized, leading to serious margin erosion for the business. So a simple missing preventive control cascades right into a real hit to our profitability.
Let's review our high-level risks, the big ones that can severely impact our financials. First up, bad debt. The cause? Maybe a credit check was skipped or not enforced. The impact is uncollectible AR and a direct hit, a literal P&L loss. Next, premature revenue. This happens when delivery isn't actually confirmed before the invoice goes out. The impact here? Overstated revenue, which triggers a massive audit risk. Nobody wants that. And third, revenue leakage. The cause here is an invoice simply not being issued after delivery. We did the hard work, but we forgot to bill for it. The impact is lost revenue and unbilled AR. For all of these high-level risks, the fix, the control direction, is the same. We absolutely must drastically strengthen our approval and monitoring processes.
Now, don't let the word medium fool you. Let's look at our medium-level risks. We already touched on quote errors causing margin erosion, but let's evaluate overstated AR. The cause is cash being received but not applied to the invoice. The impact? An artificially inflated balance sheet that causes total confusion for the finance team.
Then you've got collection errors. This is usually caused by credits being applied without updating the payment link, resulting in either over or under collection. Finally, cash flow risk. The cause here is usually lacking a structured collection cadence. If you don't have a solid rhythm for chasing down payments, the impact is late payments and very real liquidity pressure. So yeah, even medium risks can totally choke a business's cash flow.
Which brings us to Section 3, measuring health with KPIs.
Let's transition away from the warnings and risk registers and introduce our performance dashboard. As an advisor or a finance pro, you've got to be able to define, interpret, and act on key performance indicators, or KPIs. We'll start with the heavy hitter, Days Sales Outstanding, or DSO. We track this monthly, and it measures the average number of days it takes to actually collect payment after an invoice is issued. Why does this matter? Well, a rising DSO on your AR aging report literally means your cash is trapped out in the field. Think about it. If your payment terms are 30 days, but your DSO is sitting at 65 days, your clients are basically using you as a free bank, and your machine is slowing down.
Next up is the unapplied cash balance. This is cash that's hit the bank, but it hasn't yet been matched to specific customer invoices in our accounting system. We track this one weekly. Now, receiving cash is obviously awesome, but if it just sits there unmatched, our AR balance stays artificially inflated. It confuses the balance sheet, and honestly, the worst part is it might mean we're accidentally sending angry collection emails to a client who actually already paid us. Not a great look.
All right, let's group our core monthly tracked KPIs. First up, the collection rate percentage. This tells us the exact percentage of invoiced revenue we've successfully collected. Next, the on-time billing rate. This measures the percentage of invoices issued within the agreed billing window, because simply put, late bills mean late cash. Then we have the invoice error or credit note rate. This tracks credit notes as a percentage of total invoices. If you've got a high rate here, it usually means your upfront data is super messy. Escalation timeliness measures how long it takes from a due date to the first formal escalation action. And finally, revenue per billing cycle lets us monitor the total revenue billed per period so we can spot overarching trends. Together, these metrics give you a really comprehensive diagnostic view of how efficiently the machine is running.
We do have a couple of other KPIs we track on different frequencies. AR aging distribution gives us a breakdown of overdue AR by bucket, right? 0 to 30 days, 31 to 60, 61 to 90, and 90 plus days. We look at this weekly or monthly to see exactly where the blockages are. And this brilliantly illustrates the long-term view, bad debt as a percentage of revenue. Tracked quarterly, this measures our credit write-offs relative to our total revenue. If this percentage is creeping up quarter over quarter, you know your upfront credit approval controls are failing, and that directly impacts your long-term P&L health.
So, let's bring this all together. We build the machine to generate revenue, but we defend and measure it to ensure we actually keep the cash. That right there is the core philosophy of this explainer. The preventative and detective controls we just went through, those are your shield. And the dashboard of KPIs we monitor, that's your compass. You absolutely cannot have a successful revenue cycle without both.
I want to leave you with this final thought. If you applied these controls and KPIs to a client's business today, what hidden risks do you think you'd uncover? Seriously, think about that. Because in our next lesson, the advisory framework, we are going to do exactly that. We're going to take these exact tools, the controls, the risk registers, the KPIs, and apply them to a real-world client scenario to uncover those hidden blind spots. Thanks for hanging out with me for this explainer, and I will see you in the next lesson.